This AI playback is powered by Crone. Ever find yourself scrolling through Zillow and thinking a massive mansion would solve all your problems?
Well, according to Janine Mancini, the billionaire Charlie Munger actually argued the opposite. He stayed in his modest Los Angeles home for 70 years because he saw fancy houses making people less happy.
Right. I mean, if you've got billions, why keep the same place for 7 decades? It seems like a pretty extreme level of discipline.
He really believed it was a burden. He said a huge estate is mostly just good for entertaining 100 people at once, which is just a very expensive thing to do that doesn't actually help you.
I guess there's a lot of hidden work and pressure that comes with looking like a duke. Did he mention how it affects the family dynamic?
He did. He was worried it would be bad for the children. He felt that growing up in a palace-like home teaches kids that their only duty is to live grandly and spend the wealth.
So it was less about saving money and more about keeping a normal environment for them to grow up in. That's a perspective you don't hear often from the ultra-wealthy.
Exactly. He called it a deliberate choice to avoid living like royalty. It was about choosing wisdom over what everyone else was doing.
It definitely makes you rethink the whole white picket fence dream, if even a billionaire found it counterproductive. This AI playback is powered by Crone. If you wanted to triple your money on a house, where would you even start? Is it the kitchen or maybe adding a whole new room?
Well, Janine Mancini writes about how Charlie Munger actually swore by something way simpler. Trees. Just planting trees and focusing on lush landscaping.
Wait, Munger, the billionaire Berkshire Hathaway guy? I always think of him as a stocks person, not a gardener.
Right. But back in the early 60s, he was a real estate attorney in L.A. He actually developed these 442 apartments in Alhambra, California.
Okay, so he was building at scale. Were they luxury places?
No, they were modest, about $20,000 each. But they sold out incredibly fast because he refused to stint on the greenery. He called skipping the landscaping building malpractice.
So it's about that first impression when you pull up to the curb. It makes the whole place feel more permanent, I guess?
Exactly. He believed buyers react emotionally to beauty. And the National Association of Realtors backs him up, saying 97% of agents think curb appeal is vital for a sale.
It's a good reminder that sometimes the best return on investment is literally growing right in the yard. This AI playback is powered by Crone. How does one of the most famous billionaire Republicans end up being a champion for government-run healthcare?
Well, Janine Mancini actually looked into this. Charlie Munger basically thought the current U.S. setup was a Rube Goldberg machine that just happened by accident.
A Rube Goldberg machine. So he's saying it's needlessly complex then?
Exactly. He called it shot through with rampant waste. He and Warren Buffett both saw rising medical costs as a tapeworm on American business.
A tapeworm. That's a strong visual for a fiscal conservative.
He argued it puts U.S. manufacturers at a huge competitive disadvantage compared to European companies where the government handles the tab. For him, it was a math problem as much as a social one.
So what was his actual fix? Was he pushing for something like they have in Canada?
Pretty much. He wanted a single-payer system providing a basic level of care as a right, but he'd include a private opt-out for people who want something a little faster or fancier.
It sounds like he really lost faith in the private insurance model for basic needs.
He did. He even called some hospital practices deeply immoral, like artificially prolonging death just to make more money. He was convinced young people will eventually see this Canada-style system become a reality.
It's quite the legacy for a legendary investor to leave behind. This AI playback is powered by Crone. We have seen a massive shift toward passive investing, but few discuss the incredible concentration of power it creates at the top.
Right. Adrian Volinick has explored how the late Charlie Munger raised alarms about this very issue. Munger warned that index fund giants like BlackRock, Vanguard, and State Street have become a new class of emperors. They hold the voting rights for millions of individual investors, which gives them immense sway over corporate boards.
It is startling to realize that one firm, BlackRock, manages over $13 trillion in assets. How does that translate into actual corporate changes?
Okay, consider the case of ExxonMobil. In 2021, an activist fund with only a tiny fraction of shares managed to replace 3 board members. They succeeded because BlackRock used its massive voting power to support them. Larry Fink has previously used this influence to push for specific environmental and social standards across the corporate world.
Munger seemed particularly worried about the long-term consequences of this arrangement. Did he offer any solutions?
He was more focused on the risks than the remedies. He respected Fink, but was deeply uncomfortable with the idea of a single individual holding such a degree of control. While BlackRock has recently scaled back some of its social initiatives, the underlying concern remains that too much power is concentrated in too few hands. Munger believed this shift away from traditional capitalism would eventually lead to trouble.
That perspective highlights a significant tension between market efficiency and democratic governance in the financial sector. AI Playback is powered by Crone. Have you ever heard that rhythm about how smart people go broke?
Right. Janine Mancini actually wrote about this. It's the 3 Ls: liquor, ladies, and leverage. It was originally a Charlie Munger line.
3 Ls. Okay, but does Warren Buffett actually believe all three are equally dangerous?
Not really. He says Munger just added the first 2 because they started with L. The real killer, the one that produces zeros, is leverage.
So borrowing money to chase gains. It seems like such a common strategy, though.
It is, and Munger even admitted Berkshire could have been worth twice as much if they'd used more debt. But they refused to risk their shareholders' trust.
That's a huge amount of money to leave on the table. Why be so cautious?
Well, Munger lived through it. After his divorce in 1953, he lost everything, including the family home. He had to build back from nothing without borrowing.
It's a powerful lesson in why they prioritize safety over just chasing the biggest numbers. This AI Playback is powered by Crone. Why do you think Warren Buffett ended up so much richer than his partner Charlie Munger? Kind of a huge gap, right?
Well, according to Rebecca Holland, Munger actually joked about this himself. At a meeting in 2019, Buffett was worth $82.5 billion, while Munger was at $1.6 billion.
That is a massive difference for two guys who worked together for 45 years. Did Munger have a specific reason why?
He pointed to 3 simple things. Buffett got an earlier start, he's probably a bit smarter, and he worked harder at preserving those savings. Buffett actually started investing at 11 years old.
11? Okay, that gives a whole new meaning to starting young. I guess that really lets compound interest do the heavy lifting.
Exactly. Munger often talked about reaching a $100,000 benchmark first. Once you hit that, compounding really starts to show its power over the decades.
So even if we aren't starting in middle school, the idea is to just get in the market and stay there.
Right. Even though Buffett's now worth about $147 billion, the core strategy remains the same. It's about time and consistency.
It's a good reminder that sometimes the simplest habits are the ones that build the biggest fortunes. This AI Playback is powered by Crone. Did you know that according to Charlie Munger, the easiest way to be successful isn't being smart, it's actually just avoiding being stupid?
Right. Janine Mancini wrote about this. Looking back at a speech Munger gave at Harvard, he laid out these 7 ways to essentially guarantee yourself a miserable life.
7 ways to be miserable? That's a bit dark, isn't that? What was at the top of the list?
Being unreliable. He said if you break promises and miss deadlines, that habit alone will cancel out every other virtue you have.
Okay, that's pretty direct. I guess it ruins trust immediately. What else did he warn against?
He was big on learning from the mistakes of others. He actually mocked people who insist on only learning from their own personal experience, calling it a fast track to mediocrity.
So basically, read history so you don't repeat the train wrecks. I've also heard he had a very specific view on failing.
Yeah, he said if you quit after failure, you're guaranteed to stay mired in misery. He also warned against losing objectivity.
Right, like those people who refuse to change their minds even when they're staring at proof they're wrong. It's wild how none of these are about money, but they probably explain why he was so good with it. Playback is powered by Crone. Have you ever wondered why some people seem to thrive in business, while others just stay perpetually stuck in their own frustration?
Ivy Grace actually explored that recently through the lens of Charlie Munger. He believed that letting anger run your life, especially through politics, is a total trap for your brain.
Right. He was pretty blunt about it at that University of Michigan talk, wasn't he? Watching Congress. and seeing that level of contempt.
Exactly. He called it evil to hate that much. His main point was that as soon as anger enters the room, reason just leaves. It's like a cognitive shutdown.
And he had that great line about the House of Misery. If you're angry all the time, you're basically signing up for low worldly achievement.
Yeah, because that outrage becomes your identity. Munger saw it in the markets too, where investors would panic at highs and just freeze at the lows because they were reacting to noise instead of doing the analysis.
So it's really about that calm temperament he was famous for at Berkshire Hathaway. Clear thinking requires distance from the emotional drama.
Precisely. He credited his whole career to staying calm while everyone else was getting heated over policies or trends. It's about not letting your emotions shrink your perspective.
It's a solid reminder that keeping a level head is probably the best investment we can make.
A playback is powered by Crone.
Did you hear that story about Warren Buffett thinking Charlie Munger was finally losing his hearing? It is such a classic look into how they operated together.
Oh, Ananya Gairola wrote about that. Buffett actually went to a doctor because he was so worried about Charlie. The doctor had him do this test where he'd talk to him from across the room, then halfway, then right in his ear.
Right, and Buffett tries it out by asking Charlie if they should buy General Motors at 35. He gets nothing from across the room, nothing from halfway, so he finally leans right in.
Exactly, and Munger just deadpans. For the third time, yes. It turns out Buffett was the one who couldn't hear the answers.
That is hilarious. But seriously, it highlights how sharp Munger stayed. He really changed how Berkshire did business, didn't he?
He did. He pushed Buffett away from cigar butt investing, which was just buying failing companies because they were cheap. He wanted high-quality businesses at fair prices.
He had such a varied life, too, starting as a meteorologist in the Army Air Corps. It's hard to imagine the Omaha meetings without him sitting there.
It really was the end of an era at the 2024 gathering. He left a huge gap at Berkshire and the Daily Journal Court after partnering with Buffett since 1959. He was truly one of a kind.
A legendary partnership, for sure.
Playback is powered by Crone.
Did you hear about the teenager who knocked on billionaire Charlie Munger's door and ended up with a massive real estate empire?
Janine Mancini wrote about this. Avi Meyer was 17, struggling with ADHD, and actually thought Munger was Jewish because he wanted to bond over a Hebrew Bible. He wasn't, but Munger let him in anyway.
Right, and instead of pushing him toward a typical college path, Munger invited him to what he called Munger University. Just books and mentorship at 81 years old.
Exactly. They would have these kosher meals together while Munger taught him the ropes. Eventually, Mayer and his friend Reuven Grayton started buying garden-style apartment complexes in Southern California.
It's interesting how involved Munger stayed. He was picking out paint colors and reviewing floor plans for those low-density designs with all the trees.
He really insisted on that livability factor, and he made them use long-term fixed-rate debt to stay safe, which helped them grow into a $3 billion business. He mentored them right until the end.
It just goes to show how much of a difference one open door can make.
Playback is powered by Crone.
We have seen unprecedented levels of money printing across global economies recently. Is there a point where this practice becomes fundamentally dangerous for a nation like the United States?
Right. Adrian Volenick highlights that Charlie Munger warned of this exact scenario. Munger noted that while nations like Japan, Europe, and the U.S. are entering new territory, printing too much money eventually leads to terrible trouble. He suggested we are closer to that trouble than ever before.
Japan is often cited as a country that printed massive amounts of currency without triggering immediate hyperinflation or economic collapse. Why did Munger think the U.S. might not share that same fate?
Okay. Munger pointed to cultural differences. He described the Japanese as duty-filled and civilized, making them better adapted for economic stasis. He also argued that governing a multi-ethnic country like the U.S. is significantly harder than managing a mono-ethnic society with a unified national identity.
If things do take a turn for the worse, do we see parallels to the high inflation period of the 1970s?
Munger recalled the agony of the Paul Volcker era, when interest rates reached extreme levels to curb inflation. He noted that the government was paying 15% on bonds back then, which led to a long and painful recession. He expressed hope that we avoid repeating that history while remaining cautious about the current trajectory. It serves as a reminder that avoiding economic stagnation requires more than just printing capital.
A sobering perspective on the delicate balance required for long-term fiscal stability.
This AI playback is powered by Crone.
Warren Buffett is widely regarded as a market legend, yet he often emphasizes that his success isn't built on a complex, secret formula.
Right. As Fahad Salim highlights, Buffett and his late partner, Charlie Munger, viewed themselves simply as stewards of capital. Their strategy is straightforward: dream big and stay financially ready to move fast when others are fearful. Buffett famously uses the metaphor of rushing outside with wash tubs when it rains gold rather than holding out a tiny teaspoon.
It is rare for someone at that level to be so vocal about their failures. Why does he place such importance on admitting when he is wrong?
Okay, he actually considers hiding mistakes a cardinal sin for any public company. He has been very open about his own errors, like the purchase of Dexter Shoe, which eventually became worthless. He also regrets using Berkshire stock to buy General Reinsurance, noting that shareholders gave up far more value than they received in return.
He even compares business acquisitions to marriage, implying that the reality often differs from the initial pitch.
Exactly. He admits to paying too much for goodwill and misjudging people or business values. His humility serves as a reminder that even the most successful investors must navigate surprises and maintain discipline during economic storms. It is that patience and readiness that truly define his legacy.
That perspective on long-term discipline is a vital takeaway for any investor.
Is powered by Crone.
Ever wonder if the secret to a multi-billion-dollar fortune is actually just managing your expectations?
Well, according to Janine Mantini, Charlie Munger basically said exactly that. He had this rule that you shouldn't marry the absolute best person in the world, but the best one who will actually have you.
Right, so it's more about being realistic than holding out for a fantasy. He actually compared it to his investment strategy at Berkshire Hathaway, didn't he?
Exactly. He mentioned how they used to shoot fish in a barrel, but once that got too hard, they had to adapt. You have to live on whatever advantages you can actually get.
Okay, and I know Warren Buffett has shared some similar thoughts on choosing a spouse. He credits his late wife, Susie, for a lot of his success, right?
He really does. He told Bill Gates that the most important person you'll ever associate with is your spouse. Between Munger and Bucket, they had a combined 134 years of marriage, so they weren't just talking theory.
So a long marriage is basically like a compounding force for your whole life. It's about finding that person who sharpens your thinking and keeps you steady.
Exactly. It's about making the most of the real opportunities in front of you.
Definitely a grounded way to look at success and relationships.
This AI playback is powered by Crone.
Have you ever wondered if the secret to building a massive empire like Berkshire Hathaway is actually just a few simple tricks?
Fahad Salim recently wrote about how Charlie Munger attributed his success to simple mental models rather than being a prodigy. He was quite modest about it, really.
He mentioned something about inversion, right? Like looking at a problem backward.
Exactly. When he was a weather forecaster for the Army Air Corps, he didn't ask how to help pilots. He asked, how can I kill these pilots?
That is a dark way to think, but I guess it works. So he just focused on avoiding those specific disasters?
Right. He became fanatic about avoiding two things: plane icing and running out of fuel. By eliminating the ways to fail, he ensured success.
Okay, so what was that other trick he picked up during military training? Something about firing artillery shells.
He called it over and under and kapow. He'd judge a distance by purposely going a bit too far and then a bit too short to find the middle. He used that his whole life to determine the right size for his business moves.
It's refreshing to hear that such massive success can come from simple, practical logic instead of just having a higher IQ than everyone else.
AI playback is powered by Crone.
Have you ever wondered why our grandparents' generation seems so much happier, despite having so much less? It is like there is a missing link between money and being content.
Fahad Salim recently wrote about Charlie Munger's take on this. Munger grew up in Omaha during the Great Depression, and he said it was amazing how poor everyone was, yet they were not actually miserable.
Omaha in the 30s, that sounds rough. How did people even manage basics like rent or food when things were that tight.
He mentioned his uncle, an architect who went from being quite successful to making just $109 a month in Los Angeles. Even then, he could rent a house for $25 and get by.
Okay, but $25 for rent sounds like a dream now. Was it just the low cost of living, or was there more to it?
Munger felt the culture mattered more. People in Omaha prioritized being reasonable and civilized over just getting richer. He saw it as a moral duty to think rationally and help others.
Right, so a strong community really acts as a buffer. Did he have any specific family members who modeled that kind of resilience for him?
His paternal grandfather was a huge influence. He was the son of two poor school teachers in Nebraska, but he taught himself and worked his way up to becoming a federal judge.
It sounds like that environment turned a lack of resources into a real strength for them.
This AI playback is powered by Crone.
Have you ever noticed how someone could be incredibly smart but still make the most irrational decisions?
Right. Shamiksen Partacharjee wrote about how Charlie Munger actually realized that as a 7-year-old, he saw adults around him who were very talented, but as he put it, were just nuts.
So he was essentially diagnosing stupidity while other kids were out playing tag?
Exactly. He started seeking out patterns to understand why these smart people were acting so irrational. He focused on avoiding stupidity rather than trying to be a genius.
It sounds like he developed a specific checklist to keep himself from falling into those same traps.
He did. He decided early on to avoid things like envy, resentment, and self-pity because he saw how destructive they were. His core rules were simple, like not overspending your income and staying cheerful despite your troubles.
Okay, so it wasn't just about the numbers on a spreadsheet, it was about emotional control.
Definitely. He and Warren Buffett turned those childhood observations into a lifelong playbook. They stressed consuming less than you earn and staying away from toxic emotions to keep their thinking clear.
It's a great reminder that sometimes the best investment we can make is just staying rational.
AI playback is powered by Crone.
Have you ever wondered if there's a specific number where your money actually starts doing the heavy lifting for you?
Well, according to MoneyWise and some insights from Mark Tilbury, that magic number is $100,000. He basically echoes what Charlie Munger said about how you can finally ease off the gas once you hit that milestone.
100,000. Okay. But for most people starting out, that feels like a mountain, especially with the cost of living being so high right now.
Right, it is a grind. Munger even used some colorful language to describe how tough that first stretch is. But the idea is that after 100,000, compound interest stops being, well, lame.
So it's like a snowball effect. Once you have that chunk in a low-cost index fund, the dividends and growth start compounding on a much larger base.
Exactly. Tilbury actually uses something called the growth method to help people get there faster. It stands for things like gaining control through budgeting and rooting your investments early.
I like the W in that acronym too, weeding out debt. It is hard to build that first 100,000 if you are paying off high-interest loans at the same time.
Definitely. It is all about that hardened self-discipline to reach that tipping point where your net worth just starts to go crazy on its own. It makes the initial struggle worth it.
It sounds like once you clear that first hurdle, the path to being a millionaire becomes much more inevitable.
AI playback is powered by Crone.
Most financial advisors insist on broad diversification to manage risk, yet one of the most successful investors in history famously disagreed.
Right. Janine Mancini details how Charlie Munger built immense wealth while holding only 3 primary stocks. He argued that for those who truly understand business economics, owning 50 different companies is actually counterproductive. He focused his own fortune on Berkshire Hathaway, Costco, and Lilu's fund.
It seems bold to suggest that a single stock could be sufficient for a secure financial future.
Munger was very clear about that. He believed that if you are capable of identifying a superior opportunity, adding more positions just for the sake of variety dilutes your returns. He even used a real estate analogy, noting that if you owned the best mall and apartment complex in town, you would never feel undiversified.
Does this approach apply to the average person, or is it reserved for experts?
That is an important distinction. Both Munger and Warren Buffett referred to casual participants as know-nothing investors. For them, broad diversification via index funds is the best path. Munger's concentrated strategy is strictly for those with the skill to analyze underlying business value. He felt it was a mistake to pay for complex advice when the logic of concentration is so straightforward.
Thank you for clarifying the difference between professional conviction and general market participation.